Good day. My name is Kibros Neocleus, and I hold the position of General and Portfolio Manager in IC Realty Ltd. IC Realty is a Cyprus-based and licensed alternative investment fund management company regulated by the Cyprus Securities and Exchange Commission. The company specializes in real estate and private equity. In our today's presentation, we will share with you our experience and understanding in the real estate market, and we will examine how investors can save up to 35% of their investment in the real estate market in Europe using smart investment solutions.
So the presentation for today is smart investing in real estate and how to save up to 35% of your investment in the real estate market. In the market currently, there are 4 different prices that exist for the real estate. At the lowest bottom price, the lowest cost actually in our scale here is the actual cost of the construction cost and a reasonable value of land. It's actually the cost that the developer or construction company is paying to develop the project. At the higher scale, quite higher price, is the cost price of the project, which plus the reasonable value of land, of course, and includes the developer's compensation for the project management. The developer is responsible for managing all the project, for finding the architect, the construction company, for monitoring the process of the project until the end, for receiving the license from the government to start the project, and at the end of the project to receive the title deeds of the project and transfer them to the buyers. So there is a developer's compensation for this, for his work, for the project management. At the higher price is the normal market price, which is actually the actual price that the developer is selling in the market. Is the price that currently any one of us can go and find some real estate project or apartments or houses or flats to buy for himself. And the highest possible market price is the price that someone is the maximum gain that someone can earn from selling his real estate in the market. It's a premium for someone's effort to find a buyer to buy at the highest possible price. Today, this is where our discussion will go at the prices that exist in the market for the real estate. We can start with an example how it works in the normal market in our daily life. And we start with our investor, which he wants to find some investments in the real estate market. Our investor meets with his tax advisor, investment advisor, lawyer, and asks him to propose some investments in the real estate market in Europe specifically. The advisor, of course, accepts the job with his compensation to be around in the level of 5 to 10%. This is a standard normal market compensation for the effort of the lawyer or advisor to find some projects that are suitable for his investor. At the next stage, our advisor meets the real estate agent and asks the agent to propose some investment options for his investor. The real estate agent is happy to help and happy to work with the lawyer or the advisor and find investment solutions for his client. The real estate agent meets and discuss with a developer company and ask this developer to provide some projects and propose these projects to the investor. Of course, for the efforts of the agent, compensation is between 3 to 10% of the total investment amount. There are cases that the compensation can be higher than 10%, but usually in the market is something between 3 and 10%. Yeah, of course, it depends on the size of the project, on the difficulty of finding such project, of the area of the project, of a lot of things, and of course on the agreement between the agent and the developer. The developer is happy to help the agent. They are usually doing many business together. They are familiar with each other. They know the business very well, the market. And the questions that arises here are is whether there was any correct due diligence from the agent to the developer. Did the real estate agent filter out all the developers that are only the developers that are suitable for this cooperation, for this investment? Another question we can ask here is whether there was any correct negotiation of price, because the compensation of the real estate agent is a percentage of the investment amount. So the higher the investment amount, the higher the compensation the agent will receive from the developer. There are some conflicts of interest here regarding the negotiation of price. And the last question that arises here is who will do the ongoing monitoring of the project. Someone has to monitor the project from the beginning, the start of the project, until the end. The real estate agent is not his work to do that. He's not experienced on monitoring the whole investment. And he's an agent actually specializing on finding properties or other investment ideas for his clients. At the next stage, our developer, after he agreed with the real estate agent, he searched from his own portfolio of real estate and find investment solutions for the client. The developer usually receives a project management fee for his effort that we discussed before for the whole management of the project, in the range between 5 to 7%. It can be higher, but rarely. Usually the range is between 5 to 7%. The questions that arise here are, is there any correct due diligence on the project? Because the developer selected projects only from his portfolio. It's very unlikely that developer will select a project from a different constructor or developer or development company. Of course, he will select from his own projects because it's his product, is the product that he's selling, is promoting, and it's a product that knows very, very well because he developed the product or he will develop the product. And the other question that arises here is the diversification of investments. Selecting projects from a single developer is not correct diversification of investments. Now, let's see the next stage. The developer, after the agreement with the agent to start the project and finish the project, he's going to select raw materials from the provider of raw materials, such as tiles, aluminum windows, doors, cement, bricks, and other materials. The agreement is from a single provider of raw materials or producers for raw materials, because buying only from a single provider, you receive a better discount, better prices. Is a company that you are more familiar with. you know the business, you know the provider very well. So the developer always prefers to select materials from the specific provider. The questions here are, was there any correct selection of provider of raw materials based on value and quality of the materials? The other question is, have anyone conducted an evaluation of offers from several providers? Because in our example, developer, and the example is from a real world, the real market example. The developer agreed to buy materials from a single provider. During these deals, from our experience, we understand that the compensation for the developer from these deals is between 3 to 7%. Now, in the next stage, we'll discuss and see how actually the normal market price of a real estate is defined. If we break down now the normal market price is the current market price that someone can go and buy from the market. It consists of the actual cost price of the construction cost and the reasonable value of land. The advisor's compensation is the tax advisor, lawyer, or investment advisor, is the compensation of the real estate agent, the developer's project management fee, and the developer's added value from the selection of raw materials. And we receive the normal market price in the market of the real estate. The next section, part 2, now we see what happens when an investor wants to exit from his investment and liquidate his investment. At the first stage, the investor asks the real estate agent to sell his project because he wants to liquidate his investment. The investor now agrees with the real estate agent to sell all the project because, of course, the investor doesn't have the channels, he doesn't have contacts with buyers, and this is the work of the real estate agent. The agreed compensation usually is between 3 to 5% for such deals. In the next stage, the real estate agent already accepted the agreement and decides to start selling the project. He finds buyer, people that want to buy the properties, and he manages to sell the project. The questions that arise here are there any strong incentives for the agent to sell at highest possible prices? Does the minimum sale price exist? Has anyone defined the minimum sale price so the investor can in advance calculate the minimum expected returns of the project? Another question is there any specific time horizon for exit? Does the investor have the investor defined an exit strategy from before? Any plan B if there is the market demand is very weak, the market is not does not have a good demand in the market now for real estate, so he can sell his project. And the last question is there any stress scenario for such cases? What if everything goes wrong? The market falls 20% in the real estate, you cannot sell the project. Is there any stress scenario, any plan for this? Now, in the third stage, the real estate agent manages to sell all the project, and the investor received his investment amount plus some profit, and now he has to pay taxes. The question here is whether the investor or the tax advisor help the investor to invest this amount through investment tools that you can optimize your taxes. In the fourth stage, the investor receives his investment back and he calculates his profits and everything, the investment amount, and he realizes that he receives very small profit or in cases not even a profit at all. The question that we can ask here from our experience is whether there was any project manager to monitor all the process of the project from the beginning, from the purchase of land, from the foundations of the project, from the construction, the bricks, the end of the project, and actually all the process until the delivery. And did any project manager monitor the project whether any legal actions or fraudulent activities took place? Now, with all this information, we can now define the highest possible market price that someone can sell in the market. Someone can be very, very skillful or very lucky to sell a project above the market price. Now, and how this highest possible market consists from the normal market price we analyze in the first example, plus the real estate agent compensation. This is the second compensation that the real estate agent received because of the sale of the project, plus the taxes, plus the investor profits, if any, of course, and we have the highest possible market price. Now, in the part 3 of our presentation, we will discuss smart investment solutions in real estate. We will see ways to invest in the real estate market in Europe and how to save up to 35% of your investment amount when investing in the real estate. The example we concentrate based on our experience and our work, how we work and what we do. First of all, I would like to welcome you to the world of funds, alternative investment funds more specifically. As many of you know, the funds maybe are the most regulated investment tools in Europe, maybe even in the world. At the highest position is a regulator, the local regulator that regulates all functions or all investment functions from of the fund and the fund management company, and of course the entities that monitor the fund. The entities can be the investment committee of the fund management company, the external auditor of the fund, the internal auditor, the bank monitors all payments and checks all payments whether they have supporting documents, the KYC of all investors, the board of directors of the fund, and the board of directors of the fund management company. They are monitoring all activities. The administrator of the fund, his job is to monitor the calculation of the units and the unit values, of course. And the last, the depository, an independent, total independent entity that the job of the depository is to monitor on a continuous basis all the activities of the fund, all money that come in the fund, all money that goes out from the fund, all the investments one by one, checking everything. They regulate and monitor everything and report for any findings to the regulator. And of course, if something happens, we will be in trouble. Now, I'll remove my picture here so we can see better. The board of directors of how it works actually, the fund management company. The board of directors oversees and supervises all activities of the fund management team and the fund management company as a whole. The board of directors consists of people in the fund management company plus 2 independent directors, non-executive directors. And the company consists of the risk manager. His job is to monitor all the risks on an ongoing basis that the fund is exposed to, and the company, of course. The portfolio manager, his main responsibilities is to maximize the wealth of the investors and minimizes the risks. The CEO of the company, together with the general manager, they are the 2 people that monitor on a daily basis all the activities of the company. And our compliance manager, his job is to monitor all compliance and AML issues and prepare all the reports that go to the regulator and monitor all compliance if everything is correct, the KYC for the clients, for the investors, for our partners, and for anyone else we cooperate and work with. Now, how it works. The first stage, the fund manager performs a filtering process and enhanced due diligence and selects from several developers. At the second stage, our fund manager enters into agreement with the most suitable developers. He performs an enhanced due diligence and filter out few developers, and he enters into agreement with the most suitable of them. To enter into an agreement with another company, of course, you must know that both sides have to be happy, satisfied, and see future opportunities for this partnership. And both parties, of course, to be happy, we have to define from the beginning everything, the agreements, the profits, expenses, the risks, everything. So both parties will feel comfortable and be able to work together as one entity. Now, in the third stage, after the 2 parties agreed to work together, both sides agreed to open their books to each other. Both perform due diligence and KYC to each other. They check the financial stability of each other. Of course, our concern at this stage is whether the developer is financially stable and is able to perform the project. They disclose all information. The developer discloses to us the actual construction cost, the land cost, the soft cost. Soft costs can include the money paid for the license, for the architect, and for other people that need to work together with the construction company. And of course, the developer discloses to us his profit as well. The risk manager specifies the exit plan of the agreement. He also specifies the plan B. And the fund management team sets the 4 scenarios: a favorable scenario, a moderate, an unfavorable, and a stress scenario. So before signing any agreement, these 4 scenarios have to be defined, and each scenario have to explain the performance of the project under 4 different market scenarios. After this, the key information document is drafted. This key information document includes all of future profits, the risks, the cost of the investor, all costs, in description of the investment strategy of the fund. We receive an independent valuation from a valuer to double confirm whether the developer have provided fair and correct values for the construction costs and for the land. Also, we perform a loan evaluation. Our work also is to do our internal evaluation of all the projects to confirm and the valuer and the developer if the prices that they offer and suggested are correct. And lastly, the agreement on a fair management project management fee for the developer. For his efforts, the developer will receive his fee for managing the whole project. And this is agreed from the beginning of the project. At the next stage, after we open, both sides agree and open their books to each other, they agree on all costs and everything, the risks. We enter into agreements, into joint venture agreements. So we create like a company that each party has the rights in this company, in this joint venture, and we agreed to start the project. Of course, it's important for us to agree with several developers and to have several joint ventures in our fund, so the investor will have very good diversification of his money. And what we receive from this, the fund manager ensures diversification of his investments. We're selecting several developers, not only Cyprus, in all Europe. We set the strategy for correct liquidity management. It's very important the fund to have enough liquidity. So when an investor wants to exit the project earlier than the finish of the project, he will be able to sell his shares in the fund. We disclose all risks to investors. We explain to our investors the investments, the exit strategy, the profitability, the compensation of the developers, and everyone, and our compensation, of course. We provide to the investor the key information document. And something very important that we'll discuss further in the next slide is that the fund manager, and not only the company, not the company, each person in the fund management team invests his own money together with the investors. We put our personal money in the fund, we invest with the investor, and we share the risks and all interests of the project with our investors. Our investors will never be alone, and we do that because we believe in our projects, we believe in our research and our work, and from our experience, we have very good results for such projects. And another point here that I want to explain is that the investor will receive a monthly reporting for the performance of their investments. And at any time in the month, every month, he will know how his investment is performing. At the next stage, I want to show that as responsibilities of the fund manager is acting as a project manager, let's say, is performing a project ongoing overview. The fund manager is from day one until the end of the project, above the developer, and monitoring all the process, the construction, the purchases of raw materials, of the land, of finding the architect. He knows all the expenses, the cost, everything. So our job is to monitor all the project from day one until the end. So with that, we ensure that all money are invested in accordance with the agreed upon construction cost, the land is fairly valued, and soft costs are spent correctly. Of course, we receive reporting further to site visits. We receive reporting from the construction company and the project civil engineer, also on a monthly basis, to monitor and confirm that what we see here, the process of the building, is confirmed in documents signed by the project civil engineer. This we discussed before, that we perform monitoring, of course, on the construction process in all progress of the project. And let's see ethics here. Besides the very, very heavy regulations that we are as a fund management company. We have a very strong ethics. We follow very strong ethics, and some of them we can discuss here. There is a non-biased selection of developer. We don't have friends. We don't have co-partners that came partners as friends or because they provided the compensation to us. There is non-biased selections of agents, construction companies, architects, non-biased selection of projects, etc. There is no extra expenses on purchasing of raw materials. There is no agent compensation on the purchase of the project. There is no compensation of the law of tax advisors or investment advisors. There is no needless delays on the delivery of the project. There is no delays on issuance of the title deeds, no risk of failing to receive title deeds. And of course, there are no hidden fees, expenses. The project management fee and the agent fee that the real estate agent will receive only for his when the investor decides to liquid his project, to sell his project. This is the only time that the real estate agent will receive his fee for his efforts, of course, to sell the project, which is fair enough because he, as an agent, he has the channels, experience, the knowledge, the people, the connections with the buyers. However, everything is disclosed to the investors from the beginning. At this stage is what we discussed before, that we invest our own personal money in the fund. With that, we want to prove, and we also not only want to prove, it's very important that we actually believe in our project, and it's a proof actually to the investors that our interests are aligned with our investors, and we receive a performance fee. This performance fee will receive from us only if the performance of the project is above a specific hurdle rate. For example, if the performance of the fund is above, for example, 7%, we receive compensation, performance fee compensation, only at the level that is above this 7% hurdle rate. So we don't receive performance fee for lower performance. We invest our money with the investors, and we share the same risks with our investors. Now, with proper fund management, what an investor can receive: higher expected returns due to active fund management and from experienced team. Professional management of the fund. The manager's target is to maximize investors' wealth, while at the same time minimize the risks that the investors are exposed to. There are lower expected risks due to optimal risk diversification, reduced cost, investment cost, because as it's actually what we discuss today in our presentation. We monitor all the cost, everything, even the last penny, how it's paid. We never leave anything into luck. We monitor everything. So only the people who performed their work correctly will receive their compensation, and fair compensation. There is transparency of investment with monthly reporting to investors. The funds employ additional levels of protection due to the high levels of direct regulation and ongoing supervision, both by local and EU authorities and the entities we discussed before: auditors, bank administrator, depository, etc. With funds, an investor is able to optimize the taxes that he pays to the government for his profits. Of course, it depends on the investment strategy and of the investment actually. Another important thing we haven't discussed is the flexibility of investment. Investor may transfer his share to other investors, may redeem his investor, may buy more investments in the fund, may reinvest his profits, may receive income. There is a lot of flexibility of his investment. Even on specific cases, an investor may be able to redeem his shares earlier than initially agreed. And the last point here is that by an investor, by investing in a fund, with that he reduces excessive publicity due to public inaccessibility of the register of investors in the fund. Now, I would like to show to you who we are. Our team of IC Realty Limited is here. We have our with a short bio, our CEO, Mr. Roman Bielik. The second person is myself, Kibros Neokleus, General Manager and Portfolio Manager of IC Realty Limited, and Mr. Vladislav Lisovi, our Risk Manager. Would like to thank you very much for watching our presentation. Hope you are satisfied, and I look forward to discuss further with you and exchange information together, and any opinions are welcome. Thank you very much for your time, and wish you a good day.